Hello, today we are going to discuss monetary policy. We know that the responsibility of the government is to ensure the growth and development of any nation, and for this purpose, the government takes policies. The policies, the policies of the government, as far as economy is concerned, are divided into two parts: economic policy, two parts. First is fiscal policy, and second is monetary policy. The fiscal policy is related to the taxation, revenue, and today we are going to deal with the monetary policy, which let's discuss about the monetary policy in brief. It is a tool undertaken by the central bank to ensure that there is a growth and development in the country and for revising the interest rate. For doing this, the government ensures that there should be a proper money supply in the economy. This is how the monetary policy works. The purpose and objective of monetary policy is to ensure that there should be a moderate level of inflation, employment, growth and development. These are the objectives of monetary policies, and apart from this, the other objectives are ensuring that exchange rate should be in optimum level. Now let's in this topic we will discuss meaning, as I have already discussed. Second, types of monetary policy. Third, the concept of monetary policy, tools, monetary policy committee, monetary policy transmission. So these are things which we will see broadly. So now we will talk about the types. Basically, there are two types of monetary policy. First is expansionary, second is contractionary. By word itself, it shows that expansionary means government, the RBI wants to expand the economy, means RBI wants to ensure that there should be proper liquidity in the economy, there should be growth in the economy, and there should be employment. The objective is to ensure the employment through expansionary monetary policy. But in contractionary, the objective is to decrease the inflation, and while decreasing the inflation, the growth also decreases to some extent. So depending upon the situation in the economy, the RBI takes these policies, expansionary and contractionary. Now I will explain the concept, how the monetary policy of Reserve Bank of India works. Let's suppose this is RBI, and we know the banks in India are governed and regulated by RBI. Let's say these are SBI, ICICI, HDFC, and then public. So normally what happens that the banks take loan from RBI, and in return they give loan to the public. For sake of simplicity, we will take 10% interest, which is charged by RBI for giving loan to the banks. 10% loan, and in return, of course, if RBI is charging 10% from the banks will charge more than 10%. Let's take 12%, which is charged by the banks for giving loan to the public. So now we will see how the contractionary expansionary monetary policy actually works. There are certain principles, there are certain concepts which is important to understand, and if a person understands this concept, it will be easier for him or her to solve any kind of MCQ which is related to the interest rate, inflation and monetary policy. So whenever there is requirement that there should be growth, there should be employment. For example, in COVID period, people were not having money in their hand. There was a condition which contracted the economy. There was a slowdown in the economy. So in this condition, the government directed the RBI to take decision and increase the liquidity in the economy. So liquidity is very important. In an economy, there should be a proper liquidity. Liquidity means anything which can be easily bought. For example, money is a liquid amount, a liquid asset. With this, I can buy anything within short period of time. Gold is also a liquid. With gold, I can sell the gold and get money within short period of time. So anything which can be sold within short period of time is called liquid. So when we talk about liquidity in the economy, it means we are talking that we are talking about having ability to purchase something in a short span of time or in an easier manner. So this is all about liquidity. So liquidity is very important for an economy, but on the other hand, it is dangerous also. If there is too much liquidity, then there is high chances that there will be inflation in the economy, and when there is inflation, it will lead to the decrease in purchasing power of the money. Decrease of purchasing power of the money. It means that if a pen is costing 10 rupees today, tomorrow if there is inflation, it might cost 50 rupees, 100 rupees if there is high inflation. So here money is losing its value. For 10 rupees we are buying a pen, but if there is high inflation, for buying same pen we are paying 50 or 100 rupees. So this is the loss of purchasing power of money. So RBI, it is the duty of RBI to maintain that the money should have purchasing power, adequate purchasing power, but it should not lead to very high. It should not lead to the depletion of the purchasing power of money. So this is the objective of RBI. That is the reason to maintain the liquidity and to maintain the inflation, adequate inflation. Inflation is good, but too much inflation, too high inflation or too low inflation is not good for the economy, and for this interest rate is revised from time to time by RBI. Here we have taken example of 10%, that RBI is charging 10% from the bank for giving loan and banks are charging 12%. So the tools of monetary policy, we know that MSF is there, marginal standing facility, repo rate, reverse repo rate, bank rate is there. So MSF is for one night only. The banks take loan from RBI in emergency condition. This is called penal rate. So whenever bank goes to RBI takes interest rate for giving loan, and then interest rate is a little bit higher. In the same way, repo rate is another form of loan taken by the banks from RBI. It is against the security paper, backed by the security paper. And reverse repo rate is opposite of the repo rate. The RBI takes loan from the bank and in return of the security. Next is the bank rate. For repo rate, the duration is 2 to 14 days. For bank rate, the duration is more than 14 days. But how does it work in terms of maintaining or controlling the inflation and maintaining the liquidity? Whenever there is high liquidity, RBI, whenever there is high liquidity or high inflation, RBI just increases the interest rate. For example, 12%. For sake of simplicity, we are taking 12%. Otherwise, the rates are very lower. 12%. And if RBI is charging 12%, then banks will also charge more than what it has taken from the RBI. Bank will charge 14%. So we see that whenever RBI wants to decrease the liquidity, it increases the interest rate. And whenever the interest rate will increase, we know that when the interest RBI is giving loan to the banks at higher interest rate, bank will give loan to the public or to the people or institution at higher interest rate, and when there is a high interest rate, people will not go for taking the loan. People will wait till the interest rate gets lower. So in this condition, in this way, RBI decreases the liquidity in the economy because it prevents people from taking loan, investing. We know when we are having money, too much money, we are having capability to invest more. And when we invest more, there is a high chances that it will lead to inflation. So in this way, through adjusting the interest rate, RBI controls the interest rate, and when the interest rate is controlled, the inflation will be controlled. So this is the concept of adjusting or revising interest rate so that the inflation is controlled. So another tool is SLR. SLR, CRR, statutory liquidity ratio. So this is another concept. We know that if banks are having too much money, it means they will have capability to lend that money to the public. RBI doesn't want that. RBI wants that banks should have money but not too much that it increases the liquidity. So what RBI does, it blocks some money in form of SLR and CRR. SLR is the statutory liquidity ratio. The RBI says to the bank that, see, you need to keep some amount of the NDTL, net deposit time liability, NDTL. It means whatever money is deposited by the people to the bank, it is called NDTL. So RBI says that you should keep some amount of the net deposit with you in form of liquid asset. Liquid asset. What is liquid asset? Liquid asset may be cash, gold, securities. These are liquid asset. So RBI blocks some portion of SLR in form of liquidity with the bank. Bank themselves have to keep this portion with them. They are not allowed to give loan of the amount. Let's say 5%. So 5% out of 100%, 5% amount is blocked. Then another thing is CRR. Although SLR is higher right now, it is around 18 to 20%, not 5%. And CRR is another tool used by the RBI to block the money from going to the public from the bank. Here RBI says that, see, you need to park some money with us. It means the banks are depositing some amount of the NDTL deposited by the people to RBI, and for this no interest is given by the RBI to the bank. For example, let's say 5% of the total deposit is deposited to RBI. So in total we see that 20 to 23% of the total deposit done by the people to the bank are blocked by RBI for ensuring that there should be control inflation, there should be a controlled liquidity in the economy. In this way, RBI blocks some portion of SLR, CRR of the banks. Now let's see the third concept. The open market operation. Open market operation. What is open market operation? See, there are many people who are not dependent upon the banks for the loan and other things. For example, the salaried employed, the government employed, or those who are having settle a business, they are by and large they are not dependent upon the bank for the loan. So how will RBI suck the excess liquidity from their hand? RBI employs the tool that is called open market operation. Through this, RBI, we know, we'll understand this with a simple example, that in our areas or homes, the LIC agents come and say that it deposit some amount like 1 lakh rupees. After 5 years or 10 years, we will double this amount. So what we do, we take that security paper, and in return we invest that amount. For example, 1 lakh rupee is invested for 10 years in LIC security paper. So what LIC is giving us? LIC is giving us just a paper, but it is taking our money. So that 1 lakh rupees is taken away from the public, and it is invested somewhere. In this way, the RBI suck the excess liquidity from the people who are not dependent upon the banks for taking loan. So this is open market operation. So whenever RBI wants to increase the liquidity in the market, what RBI does, RBI buys the security paper. RBI takes the security paper and gives the amount to the people, and if they are having money, it means they will have liquidity, and if they have liquidity, then they will be able to invest more and more in the economy. So RBI buys the security paper, and whenever RBI wants to control the liquidity, then RBI will sell the security paper. Selling security paper means what? RBI, through open market operation, RBI is providing the security paper to the people and taking back the money that is invested. So in this way, open market operation works. So we have seen that the repo rate, reverse repo rate, bank rate, MSF, open market operation, CRR, SLR, these are the tools used by the RBI to control the inflation, and for controlling the inflation, the interest rates are revised. Let's take another example. If RBI is adopting the expansionary policy, means if RBI wants that there should be liquidity in the market, then what RBI does, RBI just decrease the interest rate, and we know that when interest rate is low, it means the banks are getting at lower interest rate, and in return the banks are giving to the people at lower interest rate. So people will be encouraged to take loan. So people will go for loan. There will be growth in the economy because that loan amount will be invested in the economy, and there will be inflation also in the economy. There will be employment, because if loan is taken, it means some business will be established, and through that business, we know that if a business is established, then employment is also generated. So in this way, when expansionary monetary policy is adopted, then the interest is decreased. In this way, this results into increasing the loan, increasing the growth, increasing the inflation, increasing the employment. On contrary, whenever RBI adopts the contractionary monetary policy or tightening the monetary policy, what RBI does, RBI just increases the interest rate. And whenever the interest rate is higher, it means that the bank will get interest at the bank will get loan at higher interest rate, and in return they will give it to the public at higher interest rate. And if there is high interest rate, the people will not go for loan, they will not take loan from the bank, they will wait. So the loan amount will decrease, and when they will not take loan, then liquidity will not be there in their hand, liquidity will not be there in the economy, and when there is less liquidity, it means it will lead to the lower inflation. So inflation will decrease. It will also lead to the decrease of the growth in the economy. So in this way, the contractionary and expansionary monetary policy works. So now let's see the tools. Whatever we talked till now are the tools of RBI. So basically there are tools are divided into two parts. First is quantitative monetary policy. The second is qualitative monetary policy. Whatever we have talked now were the quantitative part of quantitative monetary policy. Repo rate, reverse repo rate, bank rate, open market operation, CRR, SLR, these are parts of quantitative. But under qualitative, the tools are different. Tools are moral suasion. Another tool is credit margin, credit ceiling. Then there is a direct action. So whenever RBI adopts the qualitative monetary policy, it leads to taking the decisions of moral suasion, credit rationing and direct action. Let's understand this concept, because till now we have talked about the quantitative monetary policy. Moral suasion means whenever we know that the RBI is a regulator or guardian of the banks, and when banks go away from the guidelines given by the RBI, then RBI asks them, gives them the warning that you should not do this thing. Do's and don'ts are given to the banks in form of moral suasion. Credit ceiling or credit rationing is nothing but to encourage the investment or in certain sector. RBI asks the bank that, for example, to increase the investment in agriculture, RBI asks that increase the ceiling of giving the loan to the agriculture sector. And the direct action is the moral suasion is the cause and direct action is the effect. In this, RBI directly takes the action. For example, whenever banks do not obey the rules after giving the warning, consistent warning is given, then RBI at the end takes direct action in form of prompt corrective action. Prompt PCR, prompt corrective action. In this, RBI changes the management of the bank. The director of the banks are changed through the direct action. So these are the two tools employed by the RBI to control the money supply in the economy. The effect of quantitative is indirect, and it is for all the sectors. For example, if RBI is increasing or decreasing the interest rate, it is affecting all the sector, whether agriculture, industries, manufacturing, all the sectors are indirectly affected by increasing or decreasing or revising the interest rate. But in qualitative monetary policy, the direct effect is there on the sector, and a specific sector is targeted. This is very important. Specific sector is targeted under qualitative monetary policy. For example, if RBI wants to, as I have already given the example, it wants to increase the liquidity for the farmers, then RBI asks the bank to give them more and more loan under the qualitative monetary policy. So its effect is direct, it is specific to the particular sectors. So these are the tools of monetary policy. Thank you very much. In next class, we will discuss another topic.